2007 to 2008 financial crisis is something that affected the world very badly. Even so that it caused a great recession and many people to lose their jobs. Few of the famous banks even declared bankruptcy. But what happened there? And why did it happen? Everyone says the same thing about the 2008 financial crisis. Greedy bankers caused it. People bought houses they couldn't afford. Subprime mortgages destroyed the system. But here's the uncomfortable truth. If it were that simple, it would never have happened again. Because the real cause of the 2008 crisis wasn't just bad loans or greedy people. It was a system that quietly turned risk into profit, hid danger behind complex math, and convinced the world that nothing could go wrong. And when it finally collapsed, it didn't just crash banks. It wiped out trillions of dollars, destroyed millions of lives, and reshaped global finance forever. So today, let's answer the real question. What really caused the 2008 financial crisis? After the dot-com bubble burst in 2000 and the 9/11 attacks in 2001, the U.S. economy was struggling. To prevent a deep recession, the U.S. Central Bank, the Federal Reserve, made a big decision. They cut interest rates to extremely low levels. This made borrowing cheap, very cheap. Banks could borrow money almost for free. People could take loans with very low monthly payments, and market exploded because of this. The lowering of interest rates didn't walk the same path as the inflation. The U.S. government started to increase the interest rate step by step from 1% to 5.25%. From 2004 to 2007, this happened when the housing market was boomed so much that it reached the pinnacle of 69.2%. In the early 2000s, house prices kept rising year after year. This created a dangerous belief. Housing prices never fall nationwide. Banks began giving mortgages to almost anyone. Income proof? Not always required. Job stability? Optional. Credit history? Sometimes ignored. These were called subprime mortgages. Loans given to people who were risky to lend money to. This was difficult for many Americans since the homes they bought were now worth less than the price they bought. Many of them couldn't even sell their houses without owing money to the lenders. The biggest problem was that many of the people who borrowed money from banks were unable to even afford that kind of loan in the first place. But here's the twist. Banks did not care if people could pay the money back. Why? Because banks were not planning to keep these loans back. Traditionally, a bank would give a mortgage and keep it on its books for 30 years. If the borrower failed, the bank lost money. But Wall Street changed the rules. Banks started bundling thousands of mortgages together and turning them into financial products called mortgage-backed securities. These securities were sold to investors around the world, pension funds, insurance companies, hedge funds, even foreign governments. But now, risk was no longer local. It was global. And then it got even more dangerous. To make these mortgage securities look safe, banks sliced them into layers. This is called tranches. The top layers were labeled safe. The bottom layers took the risk. Rating agencies, companies meant to judge risk, gave many of these products AAA ratings, the same rating as U.S. government debt. Why would risky loans get the highest rating? Because rating agencies were paid by the banks. Models assumed housing prices would always rise. Past data ignored worst-case scenarios. Risk didn't disappear. It was hidden. Banks weren't just selling these products. They were also betting on them. Using leverage, some banks borrowed $30 for every $1 they owned. This meant small profits became huge gains. Small losses became deadly. As long as housing prices rose, everything looked fine. But the system had no margin for error. The issue of loans and mortgages was not just running in the U.S. soil. It went well beyond the international market, too. Northern Rock, a bank in England, had to approach Bank of England for emergency funding due to liquidity problem. Even the Swiss bank UBS announced losses for the year 2007 due to same subprime-related investments. Around 2006, 2007, housing prices began to slow. Then they stopped rising. Then they started falling. Borrowers with adjustable rate mortgages saw their payments increase. Defaults began to rise. Foreclosures increased. Suddenly, those safe mortgage securities weren't safe at all. Investors realized they didn't know what these assets were worth. Who was holding the losses? Trust disappeared. In finance, when trust dies, markets freeze. Till the time 2008 arrived, the U.S. economy fell into recession. Even the federal government started to reduce the interest rates by 3/4 to slow down the economic slide. But this has now went beyond the hands of the Fed. Bear Stearns, the global investment bank, collapsed and was acquired by J.P. Morgan. But the biggest fall of the crisis came when the Lehman Brothers filed for bankruptcy. This showed into the effect how deep the crisis went. All the stock markets in the world started to fall down like a dominoes falling together. In 2008, the system began to crack publicly. Bear Stearns collapsed and was rescued. Lehman Brothers, a 158-year-old investment bank, failed completely. AAG, one of the largest insurance companies in the world, needed a massive bailout. Banks stopped lending to each other. Credit markets froze. Companies couldn't get loans to pay workers. The global economy went into free fall. Stock markets crashed. Unemployment exploded. Millions lost homes, jobs, and savings. And most people had no idea how a housing problem turned into a global disaster. Let's be clear. The crisis was not caused by one thing. It was a chain reaction. Cheap money encouraged risky borrowing. Banks stopped caring about loan-quality financial products, hid real risk. Rating agencies failed their duty. Housing prices fell, breaking the illusion. Each step made the next collapse inevitable. Here's the uncomfortable question. Did we actually fix the system? Today, global debt is higher than ever. Asset prices depend heavily on low interest rates. Financial products are again complex and hard to understand. Before 2008, people said, "This time is different." They always do. In 2006, U.S. household debt was about 100% of GDP. Today, global debt exceeds 300% of global GDP. Different market, same pattern. Blaming borrowers or bankers alone misses the point. When incentives reward risk and hide consequences, collapse becomes unavoidable. When financial products are too complex to understand, risk is not eliminated, it is disguised. Low interest rates can delay pain, but they often make the eventual crash worse. The 2008 financial crisis was not an accident. It was a warning that markets driven by belief instead of reality always end the same way. The real question isn't whether another crisis will come, it's whether people will recognize the signs before it happens again. If you want to understand money, power, and the hidden systems that shape your financial future, subscribe to the channel, because history doesn't repeat itself exactly. Keep watching Currency Context.